Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially now as we get really close to the new rule changes that are about to take place on December 15th. Now, you may or may not be aware some of these rule changes will definitely have an impact on first-time homebuyers and their ability to qualify for mortgages. So what are some of these rule changes? If you're not aware, we have talked about it on the channel before, but just as a quick recap, we're talking about the 30-year amortization for first-time homebuyers and only first-time homebuyers. And we're also discussing the changes to insured mortgage rules, where the previous rule allowed a purchase price of up to $1 million or just under a million. And now we have changed, or effective December 15th, that will change to $1.5 million. And as we get really close to December 15th, we are getting a lot of calls, a lot of inquiries around how to proceed with these changes, if we should be buying now and closing after. And we've heard a large amount of information that is both correct and incorrect, a lot of really good advice and a lot of bad advice that could be putting a lot of first-time home buyers in a very dangerous position. So who you work with does matter. Now, if you have not subscribed to the channel, we invite you to go ahead and subscribe, hit that notification bell. Don't forget to leave your thoughts, questions, and concerns in the comments section below. Now, we'll want to start this conversation off by maybe prefacing a little bit of the backdrop. Over the last week or so, we've definitely got some new information, especially with a new president coming into power in 2025. With Donald Trump coming into power, there's definitely a change in the backdrop here in Canada, whether it be political or economical. His presidency could definitely impact where things are headed here in Canada, whether it means that, hey, we're going to see additional tariffs being placed on other countries that could potentially push inflation prices up, not only in the US, but here in Canada. And obviously, as we wait for these policies to sort of take effect, whether you love Trump or hate Trump, there are going to be some intended or unintended consequences when it comes to the economy. And obviously, we saw the stock market rally significantly on the news of his victory. But ultimately, we'll see how things play out with an election pending here in Canada, potentially over the next 12 months or less. So we'll see exactly how things work out. And also last week, we definitely heard from the US Federal Reserve, where they cut policy rate an additional 0.25% based on the fact that, hey, the US economy, although resilient, is definitely facing some issues when it comes to their labor market. And just this week, we also got CPI data from the US, where the inflation numbers came in relatively untouched, remained relatively level, which does give the US Federal Reserve additional cover to cut potentially next month. And this is literally the conversation, speaking of next month, is the Bank of Canada meeting on December 11th, with the Canadian economy not performing well, with definitely a lot of headwinds when it comes to immigration and growth in Canada. Well, what will the Bank of Canada do next? Will we see 0.25%, 0.5%? Ultimately, time will tell. A lot of conversation around at least 0.25%, if not more, in December. Now, with all that being put aside, we definitely have some major wins that are starting to brew that could be moving a lot of buyers who are paying attention to these particular nuances off the sidelines and back in to the real estate market. And we're definitely seeing that firsthand right here. A lot of calls, a lot of pre-approvals, a lot of purchases as more activity becomes a very important part of what we're seeing, right? Now, obviously, with the real estate market going from a downturn into potentially a more balanced market where we're seeing individuals come to the forefront now that the Bank of Canada has cut several times. I mean, this is literally what we've seen, and we're getting all that based on the fact that, hey, potentially fixed rates could be moving lower. And right now, though, unfortunately, 5-year Bank of Canada bond still hovering relatively high at around the 3% mark, as we discussed earlier on in the video about the US presidential election. Obviously, inflation tariffs, where we're going to see things move in the next little while has yet to be determined. And that is something that's really important to understand, because fixed rate mortgages, as we are aware, do not move lock in step with variable rate mortgages or the Bank of Canada policy rate decisions. Oftentimes, these two things get conflated. It's very important to understand they move on two different levers. So, although there could be some, knee-jerk reactions when things happen, ultimately, at the end of the day, when the US sneezes, Canada and the rest of the world tends to catch the cold. So we have to keep that in mind. So, all that being said, Anthony, let's talk about these new rule changes. Why are they so important? Well, as we've talked, a lot of clients reaching out to us with the aspiration of buying a home. Some of them had, put their buying decisions to the wayside, waiting to get to 20% so that they could purchase over that $1 million mark. And now with these rule changes coming in, it's definitely pushing them into the market sooner, as they fear that home prices in that price point between 1 to 1.5 and lower could definitely appreciate, move up. Now, although we don't know exactly what will happen, the Bank of Canada Deputy Governor Carolyn Rogers has pointed to some issues that she may have with obviously Canadians paying more interest. Taking on those 30-year amortizations obviously cost more to Canadians, but it does allow for more affordable measures, more better cash flows monthly for some Canadians. So this is really something to consider. Now, some of us, some viewers, some clients prefer to take shorter term amortizations as opposed to these 30-year amortizations, especially when they're purchasing home. There are some definite things that you need to consider. I mean, ultimately, yes, the longer the amortization, the more interest you will pay on the back end of that mortgage. However, there are tools and systems in place that can allow you to decrease that amortization. And that is very simple stuff, is literally increasing the frequency of your payments. Rather than pay them monthly, you should accelerate those payments to biweekly or weekly. And that alone will in turn change the overall amortization of your mortgage. In addition to that, every single mortgage should have a prepayment option. If you're able to exercise that with additional cash being thrown towards your mortgage monthly or annually, well, that will also help you with those interest, as that money goes directly towards principal and bypasses interest. So that can also help you reduce that potential for higher interest costs while still maintaining a better, more manageable monthly carrying cost mortgage payment. And another thing to keep in mind is, depending on the term of that mortgage, whether it be 1 to 5 years, well, we're telling our clients, look, at the 5-year mark, you have the option. You may have prepayment options of 15 or 10 or 20% annually with additional payments, where you can your payments by 100% or double up those payments. But at the end of the term of that mortgage, you are able to pay it off. So if you're able to, obviously in 5 years, you can pay the entire mortgage off, or you can put a larger amount of money before the mortgage renews for the next term. So there are some things to understand. Obviously, it comes down to preference, but I do believe that 30-year amortizations will move the needle for a lot of first-time home buyers that are already stretching with these home prices, especially in the GTA and some of these hotter markets, where it will give them an additional buffer monthly. Even if they're not stretching their budgets to buy more home, well, they're definitely going to cut the cost of that monthly carrying cost by reducing their payments. And ultimately, all this information is very personal. It's very catered and bespoke to you as a homeowner, a mortgage holder. So if you wanted to run your own scenarios to sort of see how these numbers play out, what a 30-year amortization means as opposed to a 25, some of the calculators, well, as you're aware, in the description box below, there is a link to our free app, and you can download it, play around with it. That definitely has a pre-qualifier, a lot of valuable tools, and you can run the options for the 25 and the 30 amortization with those purchase prices of over $1 million. So you can see what those insurance premiums would look like if you're planning on moving there. Now, another key component here with these changes is that many people think that $1.5 million threshold for insured mortgages applies to only first-time home buyers, and that is incorrect. It is actually meant for any buyer that is buying with less than 20% down. The only thing that is for first-time home buyers, amongst other programs, is the fact that you can only get a 30-year amortization if you meet a strict guideline of being a first-time home buyer. Other than that, if you're moving up from your existing home to another home and you don't have the 20%, but you're going to 1.3 or 1.4 and you have a healthy down payment, but just not 20%, you can still buy up to 1.5 insured with the default insurance premium, but you have to take the 25-year amortization. So that is something to consider. Remember, in Canada, whenever a default mortgage insurance is applied for, it doesn't mean that just the bank gets to review that. It also has to go to the mortgage insurer. And here in Canada, we have three major insurers. That's Canada Guarantee, Genworth, sorry, that's their old name. Now they're called Sagan, and CMHC, Canadian Mortgage and Housing Corporation. So ultimately, these are the three major insurers, and all their criteria, all their premiums are identical. So it doesn't really have much of a difference in which one the lender selects. Ultimately, what's important to understand is that two sets of eyes have to review that particular approval. And that is where the problem comes in prior to December 15th. We've had clients reaching out saying, hey, my realtor told me that I should buy now and close on December 17th. And that is absolutely not right. That is incorrect. You cannot do that because it takes time for the lender to approve that deal. And most lenders have a very specific window for closing. Some require 10 business days, some require 6 business days. Once the file is approved, once all the conditions are met to get that information to your lawyer, these things take time. And leaving someone exposed with such a short turnaround time, especially because the file has to get readjudicated and reapproved, is not right. So you should definitely think about it. And the other thing, the most important thing above and beyond all that, is that when you're going to apply for mortgage, you need a pre-approval. And if you're looking for a 30-year amortization, purchase price over 1 million, well, there's nothing in place at the current moment. We haven't hit December 15th yet. So although the banks and the insurers are ready for these changes, well, we're not able to issue a pre-approval or certificate with a rate hold for that particular product because it just hasn't happened yet. Now, obviously, working with a mortgage professional who understands and knows how to underwrite and review all the documentation is super important because they can look at the qualification that would happen after December 15th. But no one should tell you to go buy a home, even if you are pre-approved through a broker or lender, without confirmation or validation that it is possible. You need that insurer to review the deal and approve it and give an insurance binder, an actual insurance certificate number that would coincide with the mortgage application. So this is very important. We would never put a client in jeopardy. If someone's telling you to go buy a home and close it after December 15th and you're okay, don't worry about it, I would definitely ask for a second opinion. And as I said, because of the fact that the rules have not been put into place, one small misstep, one small mistake. Remember, if you don't have 20%, there's a very small buffer to almost no buffer if you're buying with less than 20% down on your servicing ratios. The only way to really improve that qualification if something happens is a few different things. You can either add a cosigner if you know someone or have someone on file, but that can take some time. You can increase your down payment to offset the cost or the servicing ratios that may be elevated. You can also have increased income. So obviously, if you're stretching yourself to get to a 30-year plus over $1 million, don't risk it. Just wait it out. That would be our suggestion. And then have that application ready to go. And then once December 15th kicks in, then submit the pre-approval and begin your shopping journey for your new home. But ultimately, right now, we do have clients that we're advising, hey, look, they're buying over 1 million. They want to buy, but they have 20%. Now their question is maybe, what happens if I want to do renovations? Can I pull back a little bit of that money, buy with less? That's a different story because you can approve them at the threshold of 20% at over $1 million and then pull them back as long as they're prepared to put that 20% down. It's one thing to be and have the money, one thing not to have the money and not be protected. So these are the different scenarios. So be very cautious out there on what you're doing, especially when you're applying for a mortgage. Make sure you're getting the right advice and you're not leaving yourself exposed for potential issues down the road. So we'll leave the video here. If you have any questions, always feel free to reach out. Drop us a question in the comment section below. But until next week, have a great one.